Hi colleagues, this is Nihar Jambusaria, Chartered Accountant and a life member of the Chamber of Tax Consultants. Let me at the outset congratulate each one of us on the centenary year of the Chamber of Tax Consultants. It is also a very good initiative of the Chamber to cover the important provisions of Income Tax Act 2025 and certain points of consideration involved in almost every important provision in the new Act. I am given the task of dealing with the important provisions of carry forward of losses in case of amalgamation and demerger of companies. Although major provisions which are there in Section 72A and Section 79 of the Income Tax Act 1961 are retained in Sections 116 and 119, which are the corresponding provisions to Section 72A and Section 79 of the Income Tax Act 1961 in the Income Tax Act 2025. Major provisions are retained. However, there are some changes which need our attention, and I will deal with them in this talk. Firstly, let me take up Section 72A in the Income Tax Act 1961 and Section 116, the corresponding provision in the Income Tax Act 2025. In Section 72A, we have a provision that this particular provision allowing the carry forward and set off of losses of the amalgamating company or the demerged company in the hands of amalgamated company or the resulting company are applicable only to industrial undertakings and certain entities. So Section 72A in the current Act is restrictive, whereas in the Income Tax Act 2025 in Section 116 they have opened up the scope of carry forward in the hands of amalgamated company and resulting company, although the company is engaged in financial sector and certain other specified companies which will be specified. So this is one major change which needs our attention. So now under the new Act, there will be more opening for the carry forward of losses by the amalgamated and resulting company in a few new sectors. Coming to another important change which requires our attention, in Section 72A, we had a provision that in case the conditions prescribed in this section are satisfied, then the losses of the amalgamating company or the demerged company will be deemed to be the losses of the amalgamated company or the resulting company of the previous year in which amalgamation or demerger takes place. In other words, if losses were carried forward, say for last 5 years, and in the 6th year merger or demerger happens, then from the year of merger or demerger, for a further period of 8 years, these losses would get new lease of life. However, in Section 116 of the Income Tax Act 2025, this condition has been amended, or this provision has been amended, and it has been specifically provided that in the hands of amalgamated company and the resulting company, the losses of the predecessor company will be allowed to be carried forward only for the balanced number of years. In the example that we took, where 5 years are already over after the losses were incurred, if amalgamation or demerger happens in the 6th year, only for 3 years these losses will be allowed to be carried forward in the hands of amalgamated company or resulting company. That is in the 6th year, 7th year and 8th year. It will not get new lease of life after the merger or demerger. So these two provisions need our immediate attention, and we should see that effective from 1st April 2026, whatever merger or demerger, or rather eligible merger or demerger takes place, in those cases the carry forward of losses of the predecessor company will be allowed only for the balance number of years. So much so far as section 72A and the parallel section 116 in the old and the new act are concerned. Now let us come to the restrictive section 79 in the Income Tax Act 1961. We all know that in the case of a company in which public are not substantially interested, the losses would be allowed to be carried forward only if the 51% of shareholding remains with the same shareholders as in the year of loss. In other words, if the loss is incurred in 1 year and the losses are carried forward and they are sought to be set off in a subsequent year, 3rd, 4th, 5th, whichever year, in that year 51% of the shareholding or the shareholders should remain the same. Now under the new act, the parallel section is section 119, and here the provision is slightly changed, and it provides that in the year in which the loss is sought to be set off, the shareholding to the extent of 51% should remain with the same shareholders. However, earlier the situation was that suppose loss is incurred in year 1, in year 3 there is change of shareholding beyond 49%, and in year 6 the loss is sought to be set off. Now in the year 6, if again the shareholding is restored with the same 51% shareholders who were holding the shares in year 1, the loss is allowed to be set off. Although it is controversial, there are many favorable decisions which say that you have to compare the shareholding in the year in which loss is incurred and in the year in which loss is sought to be set off. So in between, if there is a change beyond 49%, it was still possible to restore shareholding in the year in which the loss is sought to be set off. In the new act, under section 119, it will not be possible to restore the shareholding and claim the loss. So in the same example, if in year 1 loss was incurred, in year 3 after that, if shareholding changed beyond 49% and the loss is sought to be set off in year 6, and if the company tries to restore or actually restores shareholding to the extent of 51%, and it is the same as it was in year 1, it will not be able to set off the loss of year 1 in year 6. Once there is change beyond 49% of shareholding, even in an in-between year, the loss will not be allowed to be set off. So this provision requires our immediate attention. Friends, in the limited time, I have tried to cover the important changes in the new law which require our attention, and I am sure it will be helpful to all of us. Thank you so much for giving the opportunity. I thank the Chamber for asking me to study this provision and present it to you.